All right, let's get right into it. Today, we're not just looking at a stock. We're taking apart a machine. We are deconstructing Warren Buffett's 2010 shareholder letter to pull out the actual usable principles that build Berkshire Hathaway. Now, for those of us who do this for a living, this isn't just a history lesson. This is the playbook.
And we have to start with the only number that really matters, the bottom line, 490,409%. That's the gain in Berkshire's per-share book value between 1964 and 2010. I mean, it's a number so huge it almost looks like a typo. It's not. And that result is exactly why we need to understand the mechanics behind it.
But here's where it gets really interesting from an analyst's perspective. That massive number wasn't just riding a wave. I mean, the S&P itself did over 6,000%. The real signal, the alpha, is right here in the compounded annual gain, 20.2% versus 9.4%. You see, that kind of outperformance year after year for almost half a century, that's not luck. That is a system. And it's an engine we're going to take apart piece by piece.
So how did they pull it off? Well, the 2010 letter basically gives us the full blueprint. We're going to break it down into 6 core ideas, starting with how they even keep score, all the way to the financial bedrock that makes the whole thing work. First things first, the scorecard. You know, you can't really win if you don't know what game you're playing. And for Berkshire, the goal has always been incredibly clear. Increase per-share intrinsic value faster than the S&P 500. It's so simple, it's honest, and it is brutally difficult to achieve. So how do you measure something as fuzzy as intrinsic value? Well, Buffett's approach here is just ruthlessly practical. He's the first to admit that any calculation is just an estimate. So to keep things grounded, he uses book value. It is an intentionally understated proxy, something you can track, not argue about. You know, in a world that is obsessed with adjusted everything, this is just a masterclass in intellectual honesty. Okay, so if book value is the report card, what's the actual value it's trying to represent? Well, Berkshire's whole framework for this rests on 3 distinct pillars.
And here they are. It's a really elegant 3-part model. First, what do you own? That's your investments. Second, what do you earn? That's the earnings power from your businesses. And then third, this is the squishy one, but it might be the most important. How good is management at deploying future profits? It's this perfect blend of hard assets and a very sharp judgment on human capital.
Let's look at that first pillar for a second, investments. The data here shows you the explosive early days. From 1970 to 2010, per-share investments compounded at almost 20% a year. This was the era of Berkshire as the master stock picker, the investment fund.
But here's the pivot, and it's a big one. As Berkshire got bigger and bigger, the focus had to shift to pillar number 2, buying and building the earnings power of entire businesses. And as you can see, the growth here was even faster, compounding at 21%. This wasn't just a choice. It was a strategic necessity to fight against what Buffett calls the anchor of size.
And that brings us to that third pillar, management efficacy, or what I like to call the what will they do with the money test. This quote just nails it. Capital allocation isn't some boring accounting entry. It is either a massive engine for value creation or it's a bonfire. It's the ultimate test of a CEO, and it's a direct shot at any valuation model that just ignores it. And that third pillar, well, it leads directly to one of Berkshire's most powerful and durable competitive advantages, the way they actually put their capital to work. Think about it. Most companies are stuck in a box. They are basically forced to reinvest capital back into their own industry, even if the returns are terrible. But Berkshire, as Buffett says, the world is our oyster. They have 0 institutional constraints. They can look at buying a railroad and compare it directly to buying more Coca-Cola stock. They just put the money where the best risk-adjusted return is, period. That kind of flexibility is a massive structural edge. So where does all this capital come from? That brings us to the absolute core of the Berkshire machine, the financial engine that powers this entire enterprise, the insurance float flywheel.
So what exactly is float? Well, in the simplest terms, it's a giant pile of cash that Berkshire is holding from insurance premiums, money that isn't really theirs, at least not yet. It's money they'll eventually have to pay out for claims, but in the meantime, they get to invest it for their own profit. It's basically a massive interest-free loan from their customers.
And the scale of this thing is it's breathtaking. Look at this, from $39 million in 1970 to over $65 billion by 2010. This is not some side hustle. It is a colossal, constantly growing pool of capital that is the fuel for all their investments and acquisitions. But
Here is the real genius of it. Most insurance companies actually lose money on the insurance itself. That's called an underwriting loss. So they're effectively paying a fee to hold on to their float. But Berkshire, for the 8 years leading up to this letter, consistently made an underwriting profit. So their float isn't just free money. It is so much better than free money. They are literally being paid to hold and invest billions of dollars of other people's cash. It's just an incredible advantage built on pure underwriting discipline.
All right, let's shift gears from the hard numbers to something a little softer, but something Buffett argues is just as powerful. We're talking about an advantage that's incredibly hard to copy, one that acts like a deep moat around the entire business, their culture.
See, at Berkshire, literally everything is engineered to create a culture of ownership. The directors get paid almost nothing, but they own billions in stock. They hire great managers and then get out of their way. And the home office is famously tiny and frugal. The whole system is designed to attract and keep people who think like they own the place, not like employees trying to climb a ladder.
Buffett loves this Churchill quote, and it makes a critical point. Culture isn't an accident. It's built on purpose. And once you build it, that culture starts to reinforce itself. It shapes how people behave way more than any rulebook ever could. And it naturally pushes away people who just don't get it.
And finally, we get to the absolute bedrock, the foundational principle that holds this whole thing up. It's the philosophy of prudence that allows all the other strategies to work, an almost allergic aversion to debt and financial risk.
This quote is just pure Buffett. It perfectly captures the idea. You see, Berkshire's obsession with having tons of cash and a rock-solid balance sheet isn't about playing defense. It's about making sure they can always play offense when everyone else is panicking and scrambling for cash, just like they did when they deployed over $15 billion in the middle of the 2008 chaos. And this isn't some abstract corporate policy either. It's personal. It goes all the way back to a lesson he learned from his grandfather, Ernest. Back in 1939, his grandfather gave his kids $1,000 in cash with one simple instruction: always keep it on hand, just in case. Berkshire now applies that very same principle. They just add a few more zeros.
And that brings us to one last question for you to think about. When you look at the market today, with its focus on quarterly earnings and its love of leverage, which one of these core Buffett principles, long-term thinking, rational capital allocation, or just extreme financial prudence, do you think is the most ignored? Definitely something to chew on.